Okay, welcome once again to our class. We are in Taxation 231. This is Income Taxation. And we are now in Chapter 7. This is your host, your professor, Attorney Lyndon Maceren. And now we begin our lesson. By the way, Chapter 7 is about dealings in properties. So, this refers to the disposal through sale or exchange of ordinary assets or capital assets. So there are two classifications of assets could fall under ordinary or capital. So what are ordinary assets? These are stocks in trade intended for sale to customers in the normal ordinary course of business. This includes merchandise inventory like raw materials, goods in process, finished goods, and letter B, securities held or being sold by dealers in securities. Secondly, these are real properties acquired by real estate dealers or developers. So dealers or developers. And third, there are properties. These are properties used in the business, which are subjected to depreciation. No? Then we have also properties or real properties used in trade or business, including properties which are held for rent or lease to different persons. So you have to take note that these properties are either used in the business or subjected to depreciation or are sold by dealers, either dealer in securities or dealer of real estate or developers, and including merchandise inventory. While capital assets are other assets which does not fall under ordinary assets, like stocks and securities, which are held by taxpayers who are not stock dealers. And also interest in partnership and joint venture. So if you are a partner in a partnership or a member of a joint venture, then whatever ownership you held and it's sold, subsequently sold, it is a capital asset. Then goodwill. What's goodwill is the value of the trade or the business that the taxpayer is in. No? Now, if you have a store and the goodwill, meaning there are so many customers that promotes or is or likes your store, then that is goodwill. No? The value. Then number 4, these are real and personal properties which are not used in trade or business. Like example, residential house or residential lot, a personal car or jewelries. Then properties which are for investment purposes. So the sale of real properties and securities which are subject to these properties, if sold, these are subjected to final taxes, and these are called the capital gains taxes. So if real properties and securities fall under the classification of ordinary assets, they are subject to regular income taxes. So the change of purpose or intention of the sale is the determining factor in classifying the asset, whether it's ordinary or capital, at the time of sale. To illustrate, Lynn purchased a land in Busai and intending to build a residential house. Now, she held it for 5 years, but because of the sudden increase in market price of the land, she subdivided it into lots. So meaning she broke the land into small lots and promoted its sale. So if the land was sold before its conversion to subdivided lots, the transaction would be capital asset. meaning the property sold will be considered as a capital asset. But after the subdivision of the land, the lots became in an inventory, meaning they are now classified as ordinary assets. So therefore, lien's original purpose is no longer the basis in classifying the land. So there was a change. So note, if the taxpayer is not engaged in trade of business of real estate, but if the real properties are used in the business or previously used in business, then they shall be considered as ordinary asset, still ordinary asset. So second, if the properties used in business are classified as ordinary assets, they are automatically converted into capital assets if the taxpayer can prove that the assets have not been used in the business for more than 2 years. Of course, prior to the sale. And third, if the real properties of taxpayers who are engaged in trade of business in real estate are always treated as ordinary assets, even if the taxpayer is no longer a real estate dealer or not engaged anymore in real estate. This rule also applies to those engaged in trade or business of real estate but failed to operate as a dealer in real estate. So let's go to banks and trust companies. So investment in stocks and securities, which are owned by banks or trust companies, are classified as capital assets because banks are not considered as dealers in securities. However, all properties which are foreclosed by the banks, including stocks and securities for unsettled or unpaid loans, are treated as ordinary assets. So we have an illustration here. Bank of Tisa reported the following income and expense during the year. Real and properties or personal properties for banking purposes, or meaning used in the business, 50 million. So foreclosed properties, these are unsettled uh, loans or borrowings, or the borrower did not pay. So foreclosed is, in our Bisaya, it means embargo. No? The properties to secure the loan has been foreclosed by the bank. So na-embargo sa bangko because the borrower did not pay her loan or his loan. So the foreclosed properties are real, 10 million, personal, 7 million, stocks or equity securities, 5 million, debt securities, meaning bonds, 3 million. Then we have the bank invested in bonds of 2 million, and it has a trading securities of 1 million pesos. So if you are to classify which are the ordinary and which are the capital assets, these are the answers. No? Ordinary assets, 75 million, and capital assets, 3 million. So 3 million capital assets are those which are not used in the business, and those accordingly here which are investment in stocks and securities. So investments in stocks and securities are these two, 2 million and 1 million. These are the 3 million. So all the other assets from 3 million up to 50 million are deemed as ordinary assets. This one ordinary because it's used in trade or business of the bank, and these are all foreclosed properties by the bank. So these are all considered as ordinary asset. Okay. Now let's discuss cost and expenses of assets disposed. For taxable purposes, the cost and expenses of assets are treated as follows. The acquisition cost and incidental expenses in acquiring property must be capitalized, meaning they are subjected to depreciation. The adjusted cost or the book value and the expenses related to the disposition of asset are treated as reduction from the selling price. So you get the selling price minus the book value or the adjusted cost of the asset, then minus the expenses related to the sale. So example, then it gives you gain on sale or loss on the sale of the asset. So example, after using the delivery truck in business for 2 years, Mr. Mac here sold it for 150,000 pesos. The sale was subjected to a commission of 5% and processing expenses of 10%, all based on selling price. Now the truck was purchased for 90,000, and other expenses related to the purchase includes 7,000 reconditioning cost and 3,000 testing costs. So these costs here, which are related to the purchase, must be added to the purchase price of 90,000 pesos. And the truck has a 5-year estimated useful life. So we get the adjusted cost of 90,000 plus 7,000 and 3,000 gives you 100,000 pesos minus the depreciation expense, because it says here to be capitalized. So list price or purchase price of 90,000 plus the incidental costs of acquisition, and this is the cost to be capitalized. 100,000 divided by 5, which is the estimated useful life of 5 years, that is 20,000 for each year. Then times 2 years, which is the number of years which Mac has used the truck. So 20 times 2 equals 40,000. So this is now the adjusted cost or the book value of the truck, 60,000 pesos. If you add the selling expenses, which are the processing expense and the agent's commission of 5 and 10, so equals 15% of 150,000 pesos, gives you 22,500. So all in all, the book value plus the selling expenses is 82,500 pesos. So if you deduct 150,000, you get the gain of 67,500 pesos. So selling price 150 minus 82,500 from the adjusted or book value plus selling expenses gives you the gain on sale. Now since the truck is used in business, so this is considered as an ordinary asset. So measurement of gain or loss from the sale of property. So gain is equivalent to the excess of the amount realized over the basis. So, and on the other hand, loss is the other way around. Amount realized from the sale of the property, FSOP is from sale of property, is equivalent to the sum of money received plus any property received or the fair market value of any property received. So example, May reported the following items in relation to the sale of her car. She received cash of 300,000 and also a land, and the fair market value of the land is 700,000 pesos. So all in all, she received 1 million pesos. She acquired the car at 1.5 million pesos and has a useful life of 5 years, and May has used the car for already 3 years. So this is the we have to compute the depreciation of the car, no? So for 3 years, so you get 1.5 divided by 3, it's 300,000 per year. Times 3 years, that will be 900,000. So the book value of the car is 600,000 pesos. 1.5 minus 900,000 pesos. Okay, so the gain or loss on the sale is computed as follows. So we get the amount received from sale of property, which is the cash plus the land or the fair market value of the land. 300,000 plus 700,000 gives you 1 million pesos. Then you minus or deduct the basis or adjusted basis. So acquisition cost is 1.5 minus the depreciation for 3 years of 900,000 pesos. So straight line depreciation is cost divided by the years or estimated useful life of the car. And in this case it's 5 years, so 300,000 times 3 gives you 900,000 pesos. So you deduct 900 from 1.5 gives you 600,000 pesos. So the gain from the sale of the car may earned 400,000 pesos. So since this car is a personal to May or to the seller, then it is a capital asset. So there are special rules in determining acquisition cost. Number one, or first, if the property is acquired after March 1, 1913, which is the first income tax law, the basis of the acquisition cost in acquiring the asset is the basis of acquisition cost is the cost in acquiring the asset. So example, Mrs. T exchanged a portion of her land costing 1,000,000 pesos, 1,000 pesos as of March 1, 1913 for a cow with a cost of 20,000 pesos. So mas mahal pang cow kaysa land, no? The fair market value of the land and on the cow at the date of exchange was 150,000 and 28,000 respectively. Saka ng presyo sa land. So what is now how you compute the gain on exchange? So what have you received is the cow. So acquisition cost of the cow is 28,000. Then you minus the acquisition cost of the land, which is the cost of the seller or the exchanger. Then that's 1,000 pesos. To deduct, you get 27,000 gain on exchange. Second rule, if the property is acquired by inheritance, then the basis of the acquisition cost is the fair market value at inheritance date. Example, Mr. B sold an inherited land for 100,000 pesos. This is the amount received. Then the land's fair market value were 150,000 when inherited and 90,000 when sold. So which one would you use, 150 or 90,000? So in this case, according to the rule, it's the inheritance date, so it's based on 150. So 100,000 minus 150, there's a loss on the sale equivalent to 50,000 pesos. Now if the property, number 3, if the property was acquired as a gift, the basis is the same as it would be in the hands of the donor, or the fair market value at the time when the property was given, whichever is lower. So example, if Gary received a painting as gift from Rose, and Rose acquired the painting for 100,000 pesos, it has a fair market value of 80,000 when it was given to Gary. Subsequently, Gary sold it to George for 150,000. So whichever is lower, the rule is whichever is lower, so we use 80,000 pesos. So the amount received is equivalent to 150,000. That's AR minus AC whichever is lower, so we apply 80,000, and the gain on sale is 70,000 pesos. Another rule: if the property was acquired for less than full or and adequate consideration, meaning the value is higher but the value of the property is higher but the amount received is very inadequate, then the basis is the amount paid by the transferee. Example: once sold a portion of lot with a cost of 500,000 to Ella for 200,000. See, the cost of the land is 500, but it was sold only for 200,000. So subsequently, Ella sold the same to Joe for 290,000. So what is now the basis of the acquisition cost of Ella? So it should be the amount paid. So Ella only paid 200,000. So since it was sold for 290,000, then Ella only paid 200,000 pesos. So this is the amount to be deducted from the amount received. So the gain on sale would be 90,000 pesos. So 500,000 is not to be considered because Ella did not pay this one. It is the rule says that the basis would only be the amount paid by the transferee. So in this case, Ella only paid 200,000 pesos. Okay, let's go to ordinary gain or loss versus capital gain or loss. So ordinary gain is the gain derived from sale or exchange of ordinary assets, including gains from performance of services and business. So ordinary gain equals business income, which is greater than business expenses, while ordinary loss is the excess of business expense and losses over business income, derived from the sale or exchange of ordinary assets, meaning the expenses is greater than business income. So you get ordinary loss. While capital gain is the excess of value received over the determined cost from the sale or exchange of capital asset. We know this already. So you get the value received minus the cost. On the other hand, capital loss refers to the excess of the determined cost over the value received. So it's the other way around. So to illustrate, Maui shows the following data during the taxable year. Sale of inventory is 1 million. Sale of personal car, 200,000. Cost of inventory sold, 600,000. Cost of personal car sold, 150,000. Then business operating expenses is 100,000 pesos. So which are capital assets here? So based in the following data, the capital assets are the personal car only. So inventory is an ordinary asset, no? An ordinary asset. So sale of inventory is here, while sale of car is going to be here. So 1 million ordinary asset, and the cost of the inventory sold is 600,000. So you deduct that minus the business expenses of 100,000 pesos. So all in all, we have an ordinary gain, or Maui has an ordinary gain of 300,000 pesos. On the other hand, on the capital asset, the sale of the car is 200,000 and the cost of the personal car is 150,000. So deduct, then you get 50,000 capital gain. So very easy. So net capital gain. These are all the capital gains minus all the capital loss on sale or exchanges in taxable year. Excuse me. Now, example, Mr. Q acquired and sold the following capital assets during the taxable year. So, jewelry, car, interest in joint venture, house furniture. So this is the acquisition cost and these are the selling price. Okay, acquisition cost for jewelry is 400, for the car 700, for the interest in venture is 320,000, then house furniture for 100,000 pesos. Then they were sold accordingly 500, 750,000, 300,000, then 70,000 pesos. If you notice, the assets which are enumerated here does not include a real property, because real property is oh, that's okay. So let's compute the net capital gain or the loss. So deduct the SP from the AC. No, deduct the AC from the SP. No? So capital gain will be jewelry. Okay, the whichever is higher, if the SP is higher, then that's capital gain. So jewelry is gain, car is gain, interest in joint venture is loss, and house furniture is also loss. So the capital gains are the following: jewelry 100,000, the car is 50,000, so you get 150,000. Then less the capital loss for the joint venture, there's a loss of 20,000. Then furniture loss of 30,000 for a total sum of 50,000. So you deduct 50,000 from 150,000, you get 100,000 net capital gain. So meaning all of the gains in a year. No? So the net capital gain is not subjected to 6% capital gains tax because the properties sold are not real property. So this was the one which I wanted to say. No? Because the capital gains in real property are subjected to final tax of 6% capital gains tax. So here, this capital gains are not real property, so they are included in the computation of the annual income tax of the taxpayer. So they are not subject to capital gains tax. Only real properties. Okay, let's go to preferential tax treatment for capital gain or capital loss. So due to this preferential tax treatment, the determination of correct classification of an asset, whether it's capital or ordinary, is very important. So tax rules for gains or losses from sale or exchanges of capital assets or over ordinary are as follows. Net capital gain is added to ordinary gain, but net capital loss is not deductible to ordinary gain. So we must memorize all these rules. No? So net capital gain is not, we're talking about uh, properties other than real estate, no? If it's capital asset. So capital gain is added to the ordinary gain. So it's part of the ordinary income subject to ordinary income tax. But the net capital loss is not deductible from ordinary gain. Net ordinary loss, on the other hand, is deductible from net capital gain. Okay? Because it is, you can arrive here by computing the these two in arriving at the ordinary income. So you can, so you can deduct it, no? Either. So it can be added if it's a gain, you can deduct it if it's a loss. Then number 3, capital losses are deductible from net capital gain. So Here it says net capital loss is not deductible from ordinary gain, but it can be deducted from net capital gain. And fourth, for the individual, the reportable percentages of capital gain or loss shall be there A, 100% if the capital asset is held for 1 year or less. So it must be reported 100%. But if the capital asset is held for more than 1 year or long term, then only 50% of the capital asset or of the gain, capital gain or loss can be reported. Fifth rule, there is a capital loss or net capital loss which can be carried over on the following year on the and against the net capital assets. Then loss in a taxable year which may be deducted as a short-term capital loss from the net capital gain of the subsequent year, provided that the following conditions are observed. Number one, the taxpayer is other than a corporation, meaning it's a taxpayer's individual. So this does not apply on a corporation taxpayer. Then the amount of loss does not exceed the income at the year when the loss was sustained. So say the loss is 5,000, then the income is 6,000. So since you cannot deduct it because capital losses are not deductible from ordinary gain, so you can use it in the next preceding period or the next period. No? Then the holding period should not exceed 12 months. Okay. So to illustrate, Mr. Iso, a Filipino resident, had a following income and losses for 2001A or 2001B. Ordinary taxable income of 7,000, 90,000 on B. Short-term capital gain on 21A. Then short-term capital loss 21A, 18, and B. Long-term capital gain and long-term capital loss of 52,000 and 20,000 respectively. So if there's a loss here, it can be carried over to the next calendar year. Why? Because this is an individual taxpayer. It's not a corporation. So the taxable income for Mr. Isu is computed accordingly. Ordinary taxable income is 7,000. Then you add the taxable capital gain of 10,000. But the short-term capital loss, there's a short-term capital loss of 18,000. So this can only be deducted from the capital gain. So, and there's an excess of the loss of 8,000 pesos. On the other hand, on the year 21B, there's an ordinary taxable income of 90,000. Then, on the long-term transaction, reportable at 50%. Here it's reportable. In 2001A, it's reportable 100%. But in the following year, 2001B, reportable only 50%. So capital gain 26,000, capital loss 10,000. That is 16,000. No? Why only 26,000? Because only 50% of 52,000 is reportable. Then for the capital loss, only 50% of 20,000, so 10,000 pesos. So you have a capital loss or capital gain of 16,000 in the year 21B. But what do we do here? There is a loss of 8,000. We're going to, and the loss is bigger than the taxable income. So which amount should be used? we will use the amount only up to the amount of the taxable income, because it should not exceed the taxable income. So here we carry over the net capital loss of 7,000 pesos. Okay. So this is deducted from 90,000 and 16,000. So that gives us 99,000 pesos. And the first year, there's an income of 7,000 pesos. Because this amount, capital loss, cannot be deducted from the ordinary income. Stated here in the previous capital loss cannot be deducted from, or not deductible from, ordinary gain. That's rule number 1. So that's why this amount is not deducted from 7,000. Still, the total taxable income is 7,000 pesos. Now let's go to corporations. But before that, we'll have a break. Right, we'll continue with the capital gains and losses, which are now sustained by a corporation. So there are rules to observe. First, that there is no holding period, hence there is no capital loss that can be carried over in the succeeding year. So if there's capital loss for this year, it cannot be carried over. Second, the capital gains and losses are recognized to the extent of their full amount. So there's no consideration as to short-term or long-term holding basis. So there's no 50% or 100% to consider. Third, capital losses are deductible only to the extent of capital gains. And lastly, net capital losses are not deductible from ordinary gain or income, but ordinary losses are deductible from net capital gains. So in corporation, it is easier as compared to individual taxpayer. So to illustrate, Sterling Corporation has following data on its operations for 2001A and 2001B. So income from operations are the following: 150,000 and 200,000 respectively. And there's capital gains of 40,000 and 60,000, then capital loss of 50 and 40,000. So if you were to compute the taxable income, how much would that be? Of course, for 2001A, so income from operations, you can only deduct 40,000 since there is higher loss than gain. So the excess of the loss of 10,000 cannot be deducted from the income from operations. So an income of operations of 150,000 is reportable. You cannot deduct 10,000 from 150,000. Then in the year 2001B, there is capital gain, since the gain is 60 and loss is only 40. So 20,000 capital gain is added to the income from operations. So total taxable income for the 21 OB is 220,000. On the other hand, the capital loss of 10,000 pesos cannot be carried over to the succeeding year because of these rules. Unlike in individual, where there is net capital loss carried over. Okay, so as we summarize now the tax treatment of capital gain from ordinary gain or loss. So ordinary gain or loss from ordinary asset transactions are the following. Ordinary gain is part of business income and subject to normal tax. Ordinary loss is allowed to be deducted from business income and capital gains. While capital gain or loss from capital asset transactions, specifically those not real estate, the capital gain is reduced by capital loss incurred during the taxable year to get the net capital gain, which is then added as part of business income. Then capital loss allowed as deduction from capital gains only. So capital gain from capital asset, meaning real estate transactions, are subjected to capital gains tax of 6% based on the fair market value or assessed value of zonal value, which is higher. It is payable within 30 days from date of sale using BIR form 1706. It is filed and paid in the RDO BIR or at any authorized bank having jurisdiction over the property sold. So if the real property is not used in the business, if it's a corporation, and the corporation is not engaged in real estate transactions or real estate developing, then a real estate is considered as a capital asset and its sale is subjected to capital gains tax. And capital gains on real estate transactions are no longer reported as part of income subject to tax since capital gains tax has already been paid, and this is considered as a final tax. Okay, let's go to stock transactions. Stocks are securities, shares, or equity bonds issued by a corporation. These are ordinary asset if sold by dealers in securities, licensed by the SEC. So gains or losses are part of ordinary income subject to income tax. It is, in the other hand, it is considered as they are capital assets if sold by a person other than a dealer in securities. So gain is subject to final tax, which is capital gains tax, and reported as part of ordinary income. I mean, not reported as part of ordinary income. So first, we give an example to a dealer of security. So sample, B Corporation, who is a dealer of securities, sold Jollibee's Corporation's 10,000 equity shares for 150,000 pesos or 15 pesos per share. The shares of stocks have a cost of 100,000 pesos, and the sale incurred brokerage fee of 10,000 pesos. And what is the tax applicable to the sale? So the net income is 40,000. It's arrived by deducting the selling price, deducting the cost of the sale, which is 100,000 for the cost of the equity, and the brokerage of 10,000 or 110,000, then deduct it from the selling price of 150,000. So net income or gain from the sale of an ordinary asset is 40,000 multiplied by the corporate tax rate of 30%. But now this has been reduced to 25% effective July 1, 2020. So this should be 25%. So in this transaction, income tax is 12,000 pesos. So assume that the preceding example, this Jollibee shares is not sold by a dealer in securities. It's sold by a non-dealer of securities. So the seller is a non-dealer. So if it's non-dealer, then there are two aspects to consider. And these are whether the stocks were traded in the stock market or whether the stocks were not traded. So if the stocks were traded in the stock market, the sale is subjected to a percentage tax, no? And this is the rate is 6/10 of 1%, or 0.006, and this tax is called percentage tax. So sales of Jollibee Corporation's share of 150,000 times the tax rate of 0.006, and the stock transaction tax is 900 pesos. But if the stocks were traded in the stock market, the capital gains is subjected to a final tax of 15% capital gains tax. So to compute, selling price is 150 minus the cost of shares and brokerage fee of 110,000, and the capital gains is 40,000. So if they're not traded in stock market, capital gains tax is 15%. So capital gains tax is 6,000 pesos. So thus, what is showing now is a schematic diagram of the different rates. No? So if the stocks are held by dealer securities, and the answer is yes, then they are part of the inventory. And as part of inventory, they are considered as ordinary assets. Therefore, it is subjected to the normal tax and reported in the BIO form of 1701Q for quarterly or 1701 for annual. But if it's corporation, then the form is 1702Q for quarterly or 1702 for annual. And it is also subject to VAT if the annual sale reaches 3 million, or if it does not reach 3 million, it is subject only to percentage tax. But if the stocks were held by a non-dealer, it's considered as a capital asset. And if it's not traded in the stock market, it is subject to capital gains tax of 15%, and the filing and payment would be 30 days after the sale, and using BIR form number 1707. But if the seller is a foreign corporation, the rate is 5% for the first 100,000, and in excess of 100,000 it is 10%. Meanwhile, if the stock is traded in the stock market, the selling price is subjected to percentage tax of 6/10 of 1%. And the filing and payment would be within 5 days from the date of withholding by the broker. Okay. So what if the shares of stock sold are not identifiable? Meaning the cost is not identifiable. So there are rules to follow. The first one is then the cost to be assigned shall be based on a FIFO method, or the first in first out method. But if the seller maintains the books of accounts where every transaction of particular stock is recorded, then the moving average is to be used. And if the stock's dividends are received, then an allocated cost of the original cost shall be assigned to the said stock dividends, because stock dividends would increase the stocks, no? The number of shares. So example, in here the first example, there is no stock dividend. So in the books of Sarah Lee, it shows that the common shares of stocks of PNB and she purchased 50 shares at 120 pesos per share on October 20. In the following year, she purchased again on May 10, 2019, 50 shares at 140 per share. Then on September 3, 2019, she sold 75 shares directly to a buyer at 150 pesos per share. So meaning it's not traded in the stock market. So if we use the first in, first out method, we get the selling price first. No? So sold shares is 75 pesos and the selling price is 150 pesos. So 150 pesos times 75 shares gives you 11,250. We deduct now the cost of sale. So if it's first in, first out method, meaning October 20, which is the first in, should all be disposed. So there are 50 shares. All 50 shares are to be disposed. So 150 at 120. That is 6,000 pesos. Then there are still 25 shares, and remaining 25 shares shall be taken from the second purchase, which is at 140 per share. So we get the cost by multiplying 25 shares at 140 per share. So the total cost of sale is 9,500 pesos. So capital gain on the sale is 1,750. So you know how much is the capital gain here, or the rate? It's subject to 15%. Yeah. On the other hand, if we use the moving average meaning we change the cost every time there is a purchase. Okay, still selling price is the same, 11,250, but the cost of sale now changes. No? So here we are to compute the moving average. So on October, we thoroughly purchased 50 at 120, and then on May, the following year, she purchased 50 at 140. So total cost is 13,000 divided by the number of shares of 100 pesos. So that is an average of 130 pesos per share. So now we got the moving average. So 130 per share times the number of shares sold of 75 shares. So that gives a cost of sale of 9,750. So we deduct this amount from the selling price, and we get the capital gain on sale of 1,500 pesos. Then we continue. We assume further that PNB declared 100% stock dividend on November 1, 2019. So meaning after the sale on September 3, there was a declaration of stock dividend. 100%. So how many shares left here? 50 minus 75. The remaining shares are 25 shares. So since there is 100% stock dividend on November 1, then 50 times 2, 25 times 2, because 100% is additional, no, one share for each shares of stock. So 25 times 2 will now be 50. So Sarah Lee has now 50 shares. But on December 1, Sarah Lee sold again 30 common shares at 100 pesos per share. So the capital gain is computed as follows. The selling price is 30 pesos. 30 common shares at 100 pesos per share. If we use the FIFO, so here we get 3,000 pesos. With less cost of sale. If it's FIFO, 30 shares is and price is 70 pesos. Where did we get 70 pesos here? No. So 25 shares at 140. The remaining shares here. 25 shares at 140 if we use FIFO. This one. So 25 shares at 140 gives us 3,500 cost. No? Then divided by the remaining shares of 50 shares. So there's a remaining share of 25 plus stock declaration of 100%. So plus 25 total shares. Now on the hands of Sarah Lee is 50. So cost 35 divided by 50. The adjusted cost per share is 70 pesos per share. So 30 shares times 70 pesos. The cost, if you use FIFO, is 2,100 pesos. So the gain or capital gain is 900 pesos. Meanwhile, if moving average, the average cost is only 65. Because in moving average, the average cost is 130 times the remaining shares of 25, so that gives us 3,750. Divided by the number of shares of 50, the adjusted cost per share is 65. So, we have to change this. The moving average of 25 shares is 130 pesos per share. Multiply it would give you 3,250 pesos. And divided by the remaining shares of 25 shares of stock, 50, gives you adjusted cost per share of 65 pesos per share. So the cost of sale in moving average would be 30 shares of stock sold times 65. Now gives us 1,950 cost of sale minus the selling price of 3,000. So the capital gain, if you use the moving average, is 1,050 pesos. Now we move on to installment sale of shares of stocks. The rules to follow again. First, if the initial payment is less than 25% of the selling price, then the capital gains tax may be paid by installment. But if it's more than 25%, then actually this is 25% or less. No?